Hi everyone. Thank you very much for joining today's short Q&A webinar on how to navigate buying a property or indeed remortgaging. My name is Nick Sherlambus and I'm the Managing Director of Alpha Wealth. We have just launched a poll which I would ask you maybe just for the next few seconds if you'd like to answer, just in terms of getting a bit more of a sense of which area may be more appealing to you. So please do feel free to answer the poll. And we are running a Q&A, which if I can encourage you, please, to put some questions into that. We are joined by a mortgage broker today who's kindly said that they will man that for us, and we can follow up obviously in relation to any areas or any queries that people do raise. Today's supposed to be informative, and it will be followed by a short presentation by me, and then with some questions that have come in over the course of the last number of days and weeks that were compiled by my colleague, Cliona O'Donoghue, who I'm joined by today. So without further ado, just to quickly go through, and please do ask questions, as I've said. Alpha Wealth are a financial services company based in Cork primarily. We have a small presence in Dublin. There's currently 8 of us who are qualified professionals, and we provide financial advice in many different areas of personal finance, from pension advice to savings and investments to insurances. And today's topic, which is mortgage advice. We don't provide mortgages directly, but we certainly help people get mortgage ready and get the best from the loan that they draw from a bank. So just to put some context to this, mortgage rates in Ireland are one of the highest in Europe, and we are starting to see a rise come in. ICS announced earlier in the week that they're increasing their rates, which is the first time it's happened in many years. And I think this is going to be the scenario over the course of the next number of months. We anticipate that perhaps over the next 12 months, there may be gradual rises by as much as up to 1%. Now, time will tell, but again, this is something that we just need to make people mindful of. In respect of the people on the call today, and some of you may be listening to this on video, we want to try and cover off, I suppose, 3 different areas. The first is first-time buyers. So anyone who is looking to purchase a property, basically there are a few conditions that you must meet. The first of which is that you need a 10% deposit. The second is that you can typically borrow up to 3.5 times your sole or joint income. So they're the general kind of high-level rules. There are some exceptions to this, and the one thing I say to people is it's a good idea to speak to a really good mortgage broker. Generally speaking, they are better qualified to assist, and the key thing is that it gives you the ability to basically go into all the banks at the same time. The rates that are currently available for first-time buyers vary quite largely between banks, and I always say this, and I'm going to go on record and say this again. If I was looking to buy a property for the first time, I'd be looking for a rate of around 1.95 to 2.25%. That's kind of the sweet spot, really. And you can see on the screen, there's a few different lenders that will offer those sorts of rates to first-time buyers, even at 90% loan to value, which is basically how much you borrow versus the cost of the property. So there are 3 ways in which we assist people to try and pay off their mortgage early. So for those of you that have a mortgage or are looking to get a mortgage, it's all about the rate that you pay. And I'm going to go into this in a little bit more detail in a second, but there are 1 or 2 other things that you can do. For example, when you take out a mortgage or when you bought your first mortgage, you were forced to buy life cover. This is the mortgage protection that goes with the loan that the bank provides you. Now, I worked in the banks for many years. I can tell you that they weren't competitive and they certainly didn't shop around when it came to this. And a lot of people are certainly overpaying. And anyone who's paying over 30 euros a month for mortgage protection, I would ask you to reach out to us and have a review, because generally speaking, what I have seen is that a lot of people are spending way too much on this. The banks would prey on fear. They'd get people to take out additional cover, serious illness cover, income protection, and so on and so forth, and not all of which are A, suitable, and B, competitive. And that's why I would suggest that people would do that. And then lastly, in terms of ruin house insurance, which again is an insurance that you must have if you have a property, and there are variations which we can assist clients with. Typically, I would suggest it's worthwhile speaking to a broker. So the first thing is, if anyone is paying more than 2.25, I would ask you to question, what type of mortgage do you have? Are you on a fixed rate? And if so, do you know whether you can move? So it's worthwhile speaking to your current lender, and I get people to ask two questions. What is the cost of breaking your fixed rate? And the second thing is, what rate will they offer you? And some of the lenders are coming out with more improved rates. KBC and Ulster Bank are leaving the Irish market, and I've had lots of queries from people asking me about what that means to them. Now, the mortgages will carry over to the new banks that these companies move to, which looks like Bank of Ireland and Permanent TSB. But the problem for these mortgage holders is that when they get to the end of their fixed rate, they're likely to find that they're going to be offered higher rates than they currently can find. So there is a little bit of wiggle room now before the banks transfer the mortgages over for clients to try and refix their rates at a lower level, especially in the advent of what I said earlier, that rates are likely to rise. If the bank that you're with doesn't play ball or doesn't offer you a competitive rate, there is an opportunity for you to move. And I'm just going to give you a very quick example of how this may work. So hopefully you can see the screen here that Joe and Mary Bloggs, who have a 30-year mortgage, 35 years of age, who have borrowed 300,000. The cost of a 2.95% rate to them per month is around 1,256 euros. The total cost of credit over the term of that mortgage will be roughly about 150,000. If they're able to negotiate a rate down to 2.2%, which, as I said, can happen quite easily and potentially with one phone call to your existing bank, you could find that you can not only reduce the amount that you pay back, but what you could do, and the sweet thing that you may be able to achieve, is that you pay the same amount each month, and we just reduce the term of that mortgage by anything up to 3 or 4 years. And that's, again, trying to get people who can basically become mortgage free a lot earlier in life. The other thing is that the cost of savings over that term amount to north of 40,000 euros. Now, obviously, I don't need to tell you how valuable that is, but imagine making one phone call today and saving yourself 40,000. It's massively significant. And think about the effect of if you put that money instead into a pension scheme, and with the compounded effect of growth, it's going to amount to several hundred thousand euros over the term of your working life. And this is why it's so critical that people do endeavor to make sure that they do look around. I mentioned earlier about reviewing your mortgage protection, which, as I said, people perceive that there's a lot of hassle with this. And all I say to them is that let an independent broker like Alpha Wealth review it for you. I don't mind where people get advice from, as long as it's independent and as long as it doesn't cost you anything. Some financial advisors are charging, in my opinion, extortionate fees to do reviews. And what I feel for people is that it's really important to make sure that you get value, and that only would you do something if it made financial sense. So we come across a lot of clients who are paying 40, 50, 60 euros a month for this policy that they can achieve for around 20 or 30 euros a month. There's a massive difference in costs out there in the marketplace, especially if they're not discounting or brokering that type of policy. The last thing on house insurance is that there are many different providers in the market. A lot of people say to me that they shop around, but I always say to them, look, it's worth getting a second opinion, especially from someone who has no particular bias or indeed financial interest, which is ourselves. We don't sell house insurance, but we certainly broker it for our clients. So the last thing is on your reduction of mortgage costs, and I alluded to this earlier, I would suggest that one of the options maybe is to look at putting more money into your pension scheme. Now, I'm not here to try and suggest that you have to increase that, and it's about looking at what else you're spending your money on, whether it's reducing the cost of other loans that you have, or indeed putting money away for children's education. Our role as financial planners really is to find balance for our clients, and it's also to show them better opportunities. So as I say, please do ask questions. We would like to encourage you to do so. And I'd like to now invite my colleague, Clean O'Donoghue, who's, as I said, basically compiled some of the more pertinent questions over the course of the last few weeks that I'm going to run through. But we would like to take questions, obviously, from anyone in the audience, if you would maybe complete them in the Q&A section.
Okay, so the first question we have here is, how do banks calculate self-employed income?
Generally speaking, banks tend to use 2 or 3 years accounts, and they tend to average those out. So for anyone who, say, for example, is self-employed and has been self-employed for 2 or 3 years, generally speaking, the banks would just take an average over that period. Now, sometimes they do look at other things as well, but that tends to be the general rule of thumb.
Okay. Should you keep your finances separate or combine them when buying a property?
Yeah, this is one that comes up quite often, and what we find is that there's no hard and fast rule. Typically, what I always suggest is, and it's available on our website, is a free financial budgeter that people can complete. And I tend to say to people, if you're buying an asset in joint names, you want to kind of have a little bit of a combined force. It's no point you kind of acting totally separately. The reason being is that, number one, it focuses your mind. It makes sure that you're doing the things that you're supposed to. Like, for example, neither of you go overdrawn. None of you spend money on Paddy Power online, for example, which generally the banks don't like to see, certainly not too regularly. And yes, I think it makes sense to maybe set up a joint account and maybe use that as a kind of a house or an apartment account as such.
Okay, as an independent contractor, can I get a mortgage?
Yes, but it generally, again, it's a case of looking at accounts really, like how good is the contract that you have? How long have you been operating? Are there any accounts that you can provide? Are you working under an umbrella company, the likes of Finero, for example, or have you set up your own company? But again, I think it's really important to speak to a mortgage broker who can assist you more expertly in this than perhaps trying to do it yourself.
Okay, and we've had one into the chat box as well about I'm a first-time buyer. I have approval in principle, one person from several banks in Ireland looking to buy in Dublin. I'm currently renting in Dublin and not under any pressure to buy, but I'm fed up paying rent. With the current market and houses going for much more than their original asking price, should I wait to buy for house prices to come down? Are they likely to do so? Now, Shane, I know you've given your view on that, but Nick, what's your view in relation to house prices, and do you think that they will come down?
That's a really good question, and it's one that it's almost impossible to answer in that who knows, and I don't mean to sound vague, but house prices could go up in the next number of years and they could possibly go down. There was a lot of views when COVID struck that house prices were going to fall, and obviously we've seen what's happened since. What I would say is that realistically it depends on why you're buying. Is it just to avoid paying rent, or is it that you want a roof over your head and you want to put some sort of stamp on the property? And is there other advantages, such as is it closer to certain amenities, or is it that you prefer another property? So what I would say is you have to differentiate between buying to live and buying to invest. I'm not really in favor of people buying property at the moment as an investment. Part of the reason for that is that they don't always consider the risks involved, the tax implications of rental income. But all I say to people is that if you are in a position where you can buy, and yes, rents can be quite expensive, it's worth exploring. And whatever someone says to you about what's going to happen, all I say is go out, look at properties, put a price on them, make a bid, and only if you're successful and if you have a signed contract is the property yours. So a lot of people can, go around and make a decision to buy, but the biggest challenge sometimes can be not getting the mortgage. It's actually finding the right property, and that unfortunately can take months and in some cases years to do.
So that kind of leads into this question as well, Nick. Having received approval in principle from a few banks, they were reluctant to tell me the extent to which an exception above the 3.5 time income I qualify for until I have a property in mind that I want to buy, but I'm unsure about what kind of house price I want. I can even consider without this information. Would mortgage brokers have this information so I can get an idea of my upper limit in terms of borrowing for the purpose of bidding?
I'm going to invite Shane, if you can hear me, Shane, just to maybe answer that if you don't mind. I think that's probably one that's more geared towards yourself. Hello, Shane. You might be on mute, so let me sort of see.
Yeah, there you go, Shane.
Good afternoon.
Hi, Shane.
Right, is it the Conor Boyle question?
Yes.
Yes, it is.
Right. Okay. So just with regard to the exceptions, the point that's been made here is that some lenders will require you to have your property identified prior to them assessing you for an exception. Not all lenders, but most lenders do operate in that manner. And the point that's being made here is that that's very much cart before the horse. So if you were to go into the likes of the KBCs, they want you to have the property picked out, and ideally like you to have a deposit paid on the property. But to answer the question, a number of lenders there do not require that. And if you qualify for an exception with them, they do not require you to have that property. However, if you were to get an approval in principle that incorporated a central bank exemption, and you were not to use that exemption, the general rule of thumb within the lender is that you won't get it a second time. So in other words, if we give it to you once, you have an opportunity to use it. If you don't use it, we'll give it to somebody else. So that's very important. But to try and answer the question more accurately as well for Conor is that you'll see that if you were to do a small bit of Googling on the central bank exemptions, you'll see up comes, oh, we can give you 4.5 times your income. That's the very, very upper limit of an exemption, and that's really tailored to significant earners who do not have any significant debt ongoing in the background at the same time. Far, far safer to say to anybody somewhere around 4 times rather than the 3.5 times is what an exemption would get you.
Okay, very good. This is a really good response, Shane. Thank you.
I think there are quite a number of second-time buyers on the call as well today. So I suppose another question here is, if you plan to upsize a house within 5 years, is it worth overpaying the mortgage rather than saving in a bank?
So different people may have different views. My personal view is that I think you need to assess other financial, I suppose, areas. So for example, are you sufficiently funded in your pension? Because in my opinion, borrowing money at 2.25% perhaps versus getting 40% tax relief on a pension that will go tax-free, I'd rather somebody does sufficiently fund their pension scheme. So again, it's like if you have that box ticked off, then yes, maybe paying some money off a mortgage. Other areas such as, do you have any other loans? So some clients I speak to have a car loan that they're paying interest of 8% on, and then they seem very keen to try and pay down the mortgage because it's a larger borrowing, but it doesn't make financial sense for them. Obviously, credit cards being a very expensive form of debt, so ensure that you've covered off those before you embark on it. And there are other forms of savings. You know, borrowing money at the moment is quite cheap, and in lieu of that, we have to make sure that we do fund for other things, such as emergencies, such as children's education funds. So the key thing is to get professional advice. And as I say, you know, we are offering an independent financial review. There's no cost to anyone on the call. And if they would like to get a little bit more information from us, because I think it is specific to everyone's situation, and it might be a case, as I said earlier, of this balanced approach of blending, perhaps allocating that money in several different areas rather than just lump it off a mortgage and being done.
I see as well we have somebody that has raised their hand, but what I'll do is I'll just ask 1 or 2 more questions and then we'll come to them just in case it's by accident. And if they want to keep their hand raised, that's fine, and I'll allow them to unmute there in a second. I see that, yeah, the hand I think is still up. So anyway, I'll move on to the next question there, and then I'll ask to come back to that person. So how much do I need to allow for solicitors and extra costs when deciding a budget for buying a house?
I'll let you take this one again, Shane, if you don't mind. I suppose you've got more hands-on experience of this.
Yeah, absolutely. I would say that first of all is you have stamp duty, which is a tax paid to the government. I charge at generally 1% for first-time buyers in Ireland, or for all properties in Ireland currently. So if you were buying a house, take for example for 300 grand, we would say to you, stamp duty straight off the bat of 3 grand. We would say to you, depending on where you are around the country, and I do know that there's certain people on the call here that are from up the country and all various different parts, is typically you should be paying about 3 grand for your legal costs all in. Of that legal cost, that would certainly have approximately 2 grand inside in that figure for the solicitor cost. The other 900 to 1,000 euros are in restamping of deeds and land registry fees. They're more government taxes. They're unavoidable. So first of all, I'm buying a house with 300,000. Stamp duty 1% is 3 grand. All in other legal fees, including the solicitor professional fees, another 3 grand. we would say to you somewhere around 500 euros for an engineer's report. You could have a valuation for the lender, and you could have mortgaging fees, may or may not have mortgaging fees. But we would certainly be saying to somebody, you should be gauging yourself at somewhere around 7,500.
Okay, very good.
There's another question here saying, I'm single, looking to become a first-time buyer. Gross earning in 2021 was 33,266.90. Paying rent of 900 a month, 5,000 in savings, no loans. Where and how are my best options to go about getting a mortgage?
I'll take this one, and Shane, feel free to interrupt. I suppose, firstly, based on the earnings capacity, it's going to be quite challenging to get a mortgage on that salary level, especially with the advent of, I appreciate there's rent, but the fact is that there's a relatively low amount of savings. So what I said earlier about the 10% deposit, you need to maybe consider how much will a property cost. Now, depending on what part of the country you're in, you know, it may be viable to buy a property at a lower level, especially if it's an apartment. Really, what I would say is that, again, maybe reach out to us. I'd like to maybe have a bit more of a detailed conversation and talk about perhaps gearing up towards a mortgage in the future. So we come across a lot of people who are looking at maybe the next 3 to 5 years. And I think there's definitely areas that you can embark on now to improve your financial position. So, for example, interest rates, whilst it suits a borrower for a mortgage, it certainly doesn't suit a saver. And a lot of people who are looking to buy or upscale are caught in this kind of conundrum of they can't get a return on their investment, and they sometimes have quite a large amount of money sitting in the bank for quite a number of years. And there are options, and I speak openly about savings plans within one or two of the insurance companies that I think will give them a much better opportunity. And it sounds to me a little bit in this case that it might be worth considering that perhaps while you're building up this deposit and getting yourself into a position where maybe, you know, you find the asset at a level that, you know, you're comfortable with, and perhaps you may have had one or two salary increases in the meantime.
There's another question here, Nick, that is, I suppose, common for a lot of people as well. I bought a house in 2007, which was obviously our last peak, so have a tracker. I bought before I met my husband. Location didn't suit after marriage, so I'm renting that house out. And we are living in rented accommodation in a different town. So the first question here is, my husband would be a first-time buyer, but I am not. What percentage of a deposit do you need to have if we want to buy our own home? And then I'll move on to the second part of the question. So do you want to answer the first part first?
My response to that would be 20%. If either of the parties have already purchased the property, they would be classed as second-time buyers. I think I'm correct in saying that, Shane.
Right. Yeah.
Thank you.
And the second part of the question there is there an age limit to get a mortgage and we don't have any outstanding loans?
I'll let you take this one, Shane, if that's okay.
Yeah, sorry, I've just gone back online there on that one. Just 2 quick points for everybody on that, and anybody else who may have a tracker. The first and most important point is that if you have a tracker, for example, with AIB, that you were given as a residential tracker, and you currently rent that house out, and you now wish to buy another property to go and live in, if you were to go back to AIB, you've certainly risked the tracker that you have, because the loan contract you were given was for a residential property, and you are now informing them that you're renting that out. There are no central bank protections around any tracker mortgages that are not on family homes. So that's one very important point to keep in the back of your mind. To answer specifically your question is, generally it is eldest applicant next birthday to age 70 as a max. So if you're 41 today and next birthday is 42, the max term would be available to you would be a 28-year term. Some lenders are 65, some lenders are 67, and some lenders are 68, but the maximum is 70.
Very good.
Could I just continue one other one, Nick, just if you don't mind?
Yes, please, Shane. Absolutely.
Sonia's query, I was typing away the other one there, so I wasn't concentrating on what you're saying. Just on Sonia's query, Rebuilding Ireland is there and solely there for people in Sonia's situation, and it's well worth a look at. You will receive significantly more than the 3.5 times a lender will advance to you. So certainly, and I think actually Rebuilding Ireland was redrafted or reset up of late, and it's now called Home Authority Loan.
That's a really good point, Shane, and sorry, it was one that I missed. If someone wants to go about that, is there any suggestion that you can give to them? What's the best way for them to look into it?
The best way you can look into it, they've actually got a nice website. Firstly, with the product that's there, there are limits depending on what part of the country you are in as to how much a house can cost. The 3.5 times is not 3.5 times. They're not governed by those central bank rules. You have to be under a certain level of income. In that case that we see there, that is the situation. And they have a very good calculator on their website. So if you go into thinkhomeauthorityloan.ie or rebuildingireland.ie, definitely, you'll see the calculator on the website. It's a simple one to use, and it will give you significantly more than 3.5 times the income.
Very good. That's an excellent answer, Shane. Thank you.
Another question here is, do you need to have cleared all short-term loans before looking at mortgage for second-time buyers under 10k loans?
Again, Shane, I'll hand this to you. You're on a roll, so I'll let you keep going.
Okay, no bother. Right, the answer to the question is no. All right, you don't have to have them cleared, but if you are retaining those loans, they can impact the amount that you can be approved for. So in other words, if you were to come to the table and say to a bank, look, I qualify just for example 100,000, and you say I have 2 car loans in the background and I got to retain those 2 car loans in the background, they can actually affect and negate the amount of money that you can borrow. So in that situation, you may not get the full 100,000. But to answer your question, if you have significant income coming into the house already, having those loans in the background may not cause any negative impact whatsoever.
Very good.
There's another question in here. First-time buyers, builders, we've been gifted a site. Can we use this as a deposit and free up our mortgage savings for build costs?
You keep going, Shane.
Yes, you can, absolutely. Gifted a site, so your site becomes your deposit contribution towards the overall cost. So no issue whatsoever with any lender. I suppose in terms of first-time buyers or first-time builders, just be very careful that there are 8 lenders currently in the marketplace today. 2 of them are exiting, being, as Nick previously mentioned, Ulster Bank and KBC. But of the remaining lenders, you only have AIB Group, which encompasses AIB, EVS, Haven Mortgages. So it's really one credit policy. Bank of Ireland and PTSB do self-bill loans. So for example, you might say, I'd love to see the rate at Avant Money. Avant Money do not do self-bill loans. But in answering your question, yes, the site acts as your deposit and it does free up your mortgage savings for the bill costs.
Very good.
So that's the end of the questions, but what I'm going to do is just unmute the participant who had their hand raised and just see whether they... Sarah, do you want to ask a question, or was it by accident that you had your hand raised? And what I'll do as well is I'll just launch the results of the poll. I think that may have been an accident. So
so just to maybe summarize, and I'm conscious of time as well, I'd like to thank you all for attending today. I'd like to thank you, Shane. Shane has assisted us in dealing with clients. Shane is a mortgage broker in Cork, really fantastic mortgage broker, I have to say, Monster Mortgages. And if anyone would like to get more information, please come through ourselves, Alpha Wealth. Shane is extremely busy and he's very kindly given his time up today, and it's just a case of maybe making sure that we're all comfortable in terms of like the information that's provided. As I said, I can liaise directly as well. With respect to the, I suppose, the summary of the poll, I can see there that there tends to be a bit of a split between first and second time buyers, so it's nice to see. With regards to I suppose, lastly, just to finish off and say I wish you all a good long weekend. For those of you that are off, obviously, for the weekend. And genuinely, if anyone would like to get more information, there's no question too small, so please do come back to us. There is sometimes a hesitancy, especially for the second-time buyers. I appreciate, first-time buyers, look for information. Second-time buyers, and certainly those that are paying more than they should be, it may be perceived as a lot of hassle. Now, there is some hassle in moving a mortgage, there's no doubt about that, but it can sometimes be quite easy. The key thing is, though, is to get the information and then you can react to it. But it's never as difficult the second time around. You have the property already and you've already been approved by an institution in the past. So that's the main things. In relation to mortgage protection and house insurance, I know they sound like little areas, but you can save, again, a significant amount without much hassle at all. So I would encourage anybody that's on the call who does have a mortgage just to allow someone to look at it, or indeed just get in touch with us and we can provide you with an alternative quotation. And it's really simple. You know, we use DocuSign. It's a really straightforward process and it doesn't take more than 5 or 10 minutes. So I think that's everything for the questions. Let's say thank you very much again. Thank you, Cliona and Shane. And I wish you all a good weekend and hopefully we'll hear from you soon. Thank you.